My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to help you not lose too much money here. My job is not just to entertain, but to educate and teach you. So call me, 1-800-743-CNBC, or tweet me at Jim Cramer. Sell in May because the market's too high? Come on, I mean, that may not rhyme, but it's a lot more compelling than sell in May and go away. A little ditty I've hated since the first time I heard many years ago, and then sat out a terrific summer rally. Because of a rhyme. Sell in May and go away is suboptimal advice, people. But this May, it just so happens, the market's run too much versus the fundamentals, which is one reason we got skewered today. Dow plunging 622 points, the S&P losing 2.8%, and the NASDAQ nosediving 3.20% off the rails. Now, after a tumultuous week that ended in a bombshell of a decline after President Trump talked about the possibility of retaliating against China for not doing enough to stop the coronavirus, I don't love the timing here. But if there's one thing we've learned, it's that you need to take the president seriously when he threatens to take action against China, because he's done it whenever he said it. And that's bad news for the stock market. Let me put it this way. In 2018 and 2019, we went after the People's Republic with both barrels. We were in a position of strength, strong GDP growth, incredible job market. Now we're in a position of weakness. 30 million people have lost their jobs, recession unavoidable. Really not the time for a trade war, something Larry Kudlow, the president's chief economic advisor, seemed to agree with me. On when I interviewed him on Squawk on the Street this morning. The market sure didn't. That fear, combined with the already overbought state of the market and the obvious distress in the economy, has me wondering if there might be more downside next week. No, I'm not predicting a retest of the March lows. That would be too harsh. We're not going to crash again. But I think this market could use a couple more down days like today to cool itself off. I wish that they wouldn't be so vicious. With that in mind, what is next week's game plan? All right, well, first, Tyson Foods kicks things off on Monday. Not long ago, everything was coming up roses for these guys. We had a China deal, and thanks to African swine fever, China was desperate for Tyson's meat. What could go wrong? Well, it turns out a lot. The pandemic has slowed sales all over the globe. Meanwhile, the company's got a bunch of COVID outbreaks at its factories. These would be front-page stories if OSHA was actually doing its job. We own Tyson for the charitable trust, and I am furious at myself for not giving it the boot at higher levels. I just didn't do a good job, frankly. I don't want you in it. I don't want you in my...
The House of Pain.
After the close, Skyworks Solutions reports that this chip maker is one of the few pure plays in the coming of 5G wireless, which is inevitable. Every time the stock gets slammed like it was today, I think it's a buying opportunity. I didn't hear anything out of the Apple call last night to suggest there was a slowdown in handsets. That's good news for Skyworks, too. Next up, when Dr. Anthony Fauci talked about the good news about Gilead's remdesivir as a treatment for COVID-19, he talked about it as the first tool in an otherwise empty toolbox. He said it could be part of a cocktail of drugs that could potentially turn the tide. What else might be in that cocktail? Well, Regeneron's working on a monoclonal antibody drug. We're going to learn more about that when Regeneron reports on Tuesday. After the close, we have the two very challenged companies, two of the most challenged companies in the market, Disney and Occidental. I think Disney's meeting the challenge. Occidental, not so much. Think about it. Disney's got cruise ships. It's got theme parks. It's got movies, all pretty much closed. It owns a sports channel, ESPN, where there ain't no live sports. But it also has Disney Plus, which is a fabulous service when you're stuck at home. Thank heavens they developed that, huh? I think the parks may be able to open sometime this year. Although, remember, crowds are not really acceptable when you're trying to do social distancing. And still, you got a pretty hideous stock. But that said, Disney is an iconic brand. So I'd say if you own it, I'd hold it. If you want to buy it, I'd wait until after the quarter. As for Occidental, I think you got to take advantage of the fact that Warren Buffett's got his annual meeting. He might say something good about it and sell it on Monday. I mean, That meeting should be pretty somber. We're going to have to listen to what Becky Quick has to say. She's going out there. Monday may be your best chance to get out of what I think was at once great oil company that paid way too much for a company called Anadarko, which my travel trust owned. Unlike Tyson, it was good. And, didn't live happily ever after. Wednesday starts with CVS. Now, I think this company is the best feel for the health of America thanks to the acquisition of Aetna. It's also a higher-yielding stock that's down 20% for the year. Might be worth buying ahead of the quarter if you can get it in the mid-50s because it's sold off here. Trust owns it. It's been okay, not great, not bad. All right, now how about this one? Remember, Jim? Right now, autos are the weakest part of the economy aside from travel and leisure. I know some people are just itching to buy a car company. Why? Because public transit's gotten a lot more risky. Don't do it. This is not the time for auto exposure. Here's one that I like. It's come down a lot. Waste Management, 18 points from its high. Garbage company does need more construction to make its numbers. A little wary. Let's see what they say. And now that Elon Musk has slapped a sell rating on Tesla via tweet, will someone please delete his account? The hottest stock in this market is Shopify, which helps small businesses set up online. Given what we know about layoffs, quarantines, and shopping, I'm betting Shopify is an incredible quarter. The stock has run up dramatically. I think it's worth the risk. We all want to know how Moderna's coronavirus vaccine is coming along. Hopefully, they can give us a read-through when they report on Thursday. So far, they've been pretty tight-lipped about phase one. They come on. I saw them on this morning, but I'd like to know more. We also hear from Bristol Myers, which is one of my favorite stocks on earth, especially now that it's combined with Celgene. I buy some both before and some after. They've got some new drugs to talk about. Finally, on Friday, we get results from Ventas. Now, this real estate investment trust company has been struggling because nursing homes represent a huge chunk of its business, and it's tough to run a nursing home during a pandemic that's particularly vicious to the elderly. Ventas yields 10%. Oh, normally I'd like that, but wait a second. Now it's starting to feel like a red flag to me. Let's see what CEO Deb Cafaro has to say about whether the payout's sustainable. The bottom line, last night I told you the market had come up too far too fast. Even after today's decline, we're still overbought. I really do believe it's worth waiting for the market to go lower to do any buying, unless we got some incredible vaccine news over the weekend, and I don't think we're going to get that. The market got ahead of itself. That was an amazing April. Remember, it was the best since 1987. So now we're having a curb your enthusiasm moment. So please be careful out there. Let's go to Narendra in Connecticut. Narendra.
How are you?
All right. How about you?
Good, Jim. Thanks for giving me the opportunity here. I was wondering about your view on community banks and specifically NYCB, New York Community Bank. They announced earnings a couple of days ago and had a very strong quarter, but they're down to about $10. They have a 6% yield, and given their exposure to the New York real estate market, I was wondering whether you think they could sustain their performance.
No, I think if I own that stock, I would sell that stock. I mean, I don't care about yield when it comes to financials. I care about safety right now, and I just don't trust the financials. Even the best are going down and have just been obliterated. Larry in Florida. Larry, you're up.
Coming to you with a sunny booyah.
All right, Larry, what's up?
I called today to ask about a household name, an institution, one that's performing well during these turbulent times. So post-earnings, it exceeded analysts' expectations. And after considering their moves to protect margins against headwinds and with apparently ample liquidity, what are your thoughts on Whirlpool for the upcoming year?
Well, it's down almost 25% for the year. Yields 4, but I'm not crazy about it. In a recession, you don't buy expensive appliances, and they've got the ones where they make the most money on are the expensive ones. So I'm gonna have to say no to that one. They did acquit themselves well, and it was a good interview yesterday on CBC. All right, even after today's decline, this market is too high. So I want you to be exercise caution. On May Monday tonight, Clorox posted its biggest rise in quarterly sales in a decade, proving just how popular its cleaning products are during the coronavirus pandemic. You know that, so do I. I'm getting the latest from the CEO. Then cosmetics companies are dealing with the fallout from the closure of department stores, airport duty-free shops, and beauty parlors because of COVID-19 lockdowns. What's Estee Lauder signaling? Wow, that's an exclusive. They don't do TV. And Seattle Genetics just jumped 8% after earnings and some stunning sales. This may be the real biotech that they are doing so well with their anti-cancer franchise. We're going to sit down with the CEO, break down the report. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Kramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.